For those of you who've joined and who don't know me, I'm Brian Apey, the president of Congressional Capital. We do real estate hard money lending. I also develop extensively in the city, and Ian and more recently Nigel through kind of that side of my business. A lot of small multifamily buildings, kind of 40 units or less. But I own self-storage and some office and various other things. But I'll really let maybe Ian start and just kind of introduce himself, talk to you guys about what he does, and then I'll generally moderate and we'll kick things off. So
yeah, Ian Ruel with Feldman, one of the managing principals at Feldman Ruel. Me and my partner Josh were over at Marcus & Millichap for a number of years. We left in 2020 to start Feldman Ruel. We have grown from 7 employees and agents to up to 20 employees and agents now. So we've got an investment sales division that focuses in the DMV, do about 75% of our transactions in DC, and then the balance in Northern Virginia, Montgomery County, and PG County. Focus on retail, office, mixed use, a little bit of existing multifamily over the last couple of years here. Focus on a number of different product types.
My name is Nigel Crayton. I work at Greysteel. We're a commercial real estate firm. Started here locally in the district and have branched out to 15 offices now across the country. My main focus is middle market multifamily. How I describe that, it's probably $1 to $25 million, kind of urban infill throughout the Mid-Atlantic. We also have a capital markets team, which can help place debt. We're not a direct lender per se, like a guy like Brian who actually can do the funding for you, but we can connect you with folks, guys and girls, Fannie Freddie agency throughout the nation, and kind of help projects once they're stabilized go into permanent financing.
what you've seen, in the last few years. So, we obviously had a low interest rate environment, lots of transactions, et cetera. Ian, why don't you start first and, tell us about 2023 for you guys. Like, what did that look like in comparison to 2022? We'll start there.
Yeah, I mean, 2023 it's been tough. I think regardless of where you are in the real estate industry, like it's a tough time right now. And I kind of saw it coming like late 2022. And I remember talking to our agents before 2023 started and just said, hey, this is all anecdotal, but it feels like, there's a lot of talk about rates starting to increase. There's a ton of talk about it. I feel like people, even though they knew it was coming, they didn't fully realize what it was going to mean for values and how difficult it was going to make things in our space. And so I remember having this conversation. I'm like, hey, my sense is that things are going to be a lot more challenging next year. There's going to be less transactions and you're going to have to work, effectively twice as hard to make 80 cents on the dollar. And that's exactly what it's been, right? It's just been like a slog all the way through the year. Deals that, you could have put on cruise control in 2022 and just kind of got through as a broker. Now you're just having to be so much more hands-on in every step of the process, whether it's the lending process, whether it's the due diligence process, whether it's the buyer qualification process, or just finding buyers, frankly, right now is a challenge. I mean, the buyer pool is, like, you name the product type. It's, if there were 10 groups looking at a deal back in 2022, there's 1 or 2, and you're lucky if one of them is qualified. And it's only the early stages, in my opinion, right now, like the early stages of filling that gap, because right now we're just seeing, construction debt conventional is, if you're lucky, it's 9.5%. And, that's not as much of a gap between the private money and the conventional financing as it was a year ago. So it's definitely been an interesting year for us.
Yeah, I mean, speaking of that quickly, that what it really too is that, if a local bank's at 9.5 on construction debt and they're requiring you to have a compensating balance. So like put in, if you want a $2 million loan, they're requiring you to put 300 grand in, 400, more than that, maybe into an account. It's just sitting there, and you go to a hard money lender and you're like, hey, what would you charge? And they're at 11 or 12 and some points, but you don't have to put money in an account. It looks a lot better, right? So, the hard money space, it's no secret, is really, really, really busy now, and you can sort of price it, not saying where you want, but it's much different than it was a few years ago. Nigel, what about you in terms of 2023? Is it sort of the same story that Ian was telling? Why don't you tell everybody about your 2023 and kind of what you saw?
Yeah, definitely. And when I'm talking today, I'm going to mostly talk about like existing multifamily. So a lot of the stats and stuff that I'm going to bring up are regarding to that. So before our call, actually, this conversation, Brian kind of let us know what the conversation would be about. It piqued my interest. So I kind of pulled some data over the past 10 years. So transaction volume, we're down 47% year over year, right?
Mm-hmm.
So year to date so far, we're at 66. In 2022, that number was 123 in total transaction volume of 5+ units. So that's a pretty telling number. The previous low over the past 10 years was 2017. That number was 92, right? So we're still 25 to 30% lower than any other time over the past 10 years. From a price per unit standpoint, the running average over the past 10 years was 220. We're now at 187. So that's a 20 to 23% drop in price per unit numbers as well. And then obviously the 10-year went up pretty dramatically over the past, let's say 3 years. The 10-year average on 2020 was a hair under 1%. Now we're close to 4%, right? So those numbers are pretty drastic. So what I did is I actually just kind of wrote some, like, jotted some notes and some quick things and what I saw. So obviously falling transaction numbers, 50% year over year, like that, those numbers are crazy. Dropping valuations anywhere between 20 to 30%. I would put an asterisk next to that, though, because those numbers are all based off of 2020 to 2021 numbers when kind of pricing was at all-time highs, right? So if the numbers went up 20% and they dropped 30% from there, you're really only down 10%, but you're still down pretty dramatically, which is some interesting data. Other things I'm seeing, obviously the 10 years at the highest level it's been over the past 10 years. It's grown at the fastest level it's ever grown in a 16-month period. From a cap rate perspective, we typically see debt and cap rates run hand in hand. So kind of the old rule of thumb that I've seen is on every 150 bip increase in debt, there's a 60 bip increase in a cap rate. So we've seen cap rates go up pretty dramatically to obviously make up for that, the yield that the banks are charging you. From a ownership standpoint, we're seeing kind of a shift from local banks, like Ian alluded to, a lot of pref equity, a lot of hard money lenders, guys and girls that can close quickly and aren't costing the same as a bank. Again, that kind of goes into the increased borrower costs that Brian was alluding to, tightening credit availability. We're seeing kind of a pretty wide, and again, I'm sorry, I'm just kind of jumping all over the place here, but we're seeing a pretty wide bid to ask spread. So when you tell an owner that 12 months ago their property is, again, fake numbers here, it's worth $100, and then 12 months later rents have gone up, the property performance looks better, but now it's worth $75 to $80. That's a pretty big drop for someone to comprehend. So we're still kind of having those conversations about where the market is. So there's still a pretty wide bid to ask spread and where things should be. We're seeing the attractiveness of, like, risk-free money, right? Like if you can go to a CD or a savings account and get a 5 or 6% return on your money, like that's tough to compete on these heavy value add deals that some of the stuff we sell. So that's why we're seeing some folks on the sideline. And then the last point I bring up is we're seeing kind of a shift from heavy value add to light value add. Obviously, as the cost of debt gets more expensive, there's more risk in that. So construction projects or full gut renovations or things like that, we're seeing those kind of business plans and strategies shift to something different. So again, just news and notes on things that I just jotted down. That's a lot of what we're seeing. And it all just goes back to the cost of capital. As it gets more expensive, obviously there's more risk to do these deals, and the market has responded accordingly to that.
And just one thing that Nigel said, this is like one of the most important things that I'm seeing in our business is, we sell maybe 10, 20% of what we sell is like fully stabilized, fully baked out, just like cap rate deals. And, when interest rates were 3-4%, obviously it does make sense in some situations to pay a 5 cap to pay a 6 cap. Our biggest competition right now in those deals is deposit accounts and CDs. So people saying, why would I buy a 5 cap rate deal when I can just, put my money in a CD?
Risk-free.
Risk-free. So until rates come down, it's going to be really difficult to get people at the table on some of these deals where they are like fully baked out. And the alternative is just put your money with your bank account and getting 5-6%.
So to that point, where are you seeing on a cap rate basis things trading like in DC? Obviously depends on, asset quality and various other factors, but like just kind of run the gamut real quick if you don't mind.
Yeah, I mean, they've gone up. I would say, yeah, to your point, it's really tough in DC because, like, if I was selling triple net assets like all around the country, I could say, hey, McDonald's trading at a 5 cap, and Long John Silver's is selling at a 7% cap rate. In DC, it's just number one, it's really kind of block by block, neighborhood by neighborhood, asset by asset. But on top of that, there's haven't been enough transactions for anyone that says, any appraiser, any buyer or any seller that says like, hey, here's where the market is. There hasn't been enough data for us to figure out where cap rates are anywhere. So a good example right now is we're under contract on a fully stabilized mixed use building in Adams Morgan, ground floor retail, Michelin grade restaurant on the ground floor with 4-bedroom multifamily unit above. And we're under contract in the 7 cap rate range. And that deal, I gotta think, I guess we'll never know because, we can't really run dual tracks here, but that's probably a 5.25 to 5.5 cap deal back in 2020 or 2021. So yeah, interest rates really do matter for these, fully stabilized, fully baked out deals in a big way.
I was going to say a 7 cap. I think that kind of sounds safe. And again, every deal is different, right? You're buying a deal in DuPont Circle, right? You're not getting a 7 cap. But I'd say 50 bips to 100 bips above where debt is. I think the 10-year was, I don't know what it was today, but I think that's at 6.25 today on like stabilized, like Fannie Freddie stuff. So I think 7 to 7.25, 7.5 sounds about right for where folks are buying. Because again, no one's buying a commercial real estate deal to be negative leverage day one. There needs to be a little bit of a spread to be able to get a return and again compete versus the risk-free money in which Ian was previously talking about.
Yeah, so I guess your pitch is buy it now, and then you're going to refi. There's going to be a lot of fairway ahead for you. Just suck it up and that sort of thing. I think
we're pointing a lot to price per square foot right now, and just saying totally. Hey, we understand that this is a 7 cap, this is a 6.5 or 6 cap deal, but like, hey, you're buying a 400 a foot where we can show you. Transactions over the last 10 years that have traded for well in excess of that. So that's what we're trying to point to right now is you're getting good value. The consensus across the board is that rates are going to start coming down. Are they going down to 3% ever again? Probably not. Are they going to stabilize around hopefully 5%? I'd like to think so.
Cash out refinances are going to look pretty good a year or two from now versus where before you could cash out refi within the first like 6 months of stabilization. So the business plans have shifted. And I think I saw a question from Bojan. I don't think that there's a interest rate number in which the interest rate needs to be for the market to open up. I just think it can't keep going up, right? Because no one wants to buy a deal where they're underwriting to an exit interest rate at 6.25 and then it goes up to 7%. Doesn't make sense, right? As long as it's kind of been shown that the interest rates are not going to go up, I think that's what's going to open the market up, especially once that first rate cut happens, which showcases that, hey, we're getting back to normal. Inflation is under control. We're going to be able to start cutting rates to more market levels per se, versus where we have been in the last couple of months.
So it's probably like another year before things are really active again.
I'm saying 2026, 2027 is when the market fully rebounds.
That's probably right.
Because I've seen what I've like looking at like past stuff, 2008, .com bubble, you name it. It typically takes 2 years post bottom out for pricing to recover. I think sales activity is going to pick up pretty dramatically next year, just because again the Fed kind of signaled where we are, and syndicators need to get paid fees, acquisition guys need to be paid fees, lenders need to be paid fees, right? Like, you always want to track how people make money, and no one made money this year, so they're going to want to make money next year. So I think that's going to start picking up transaction volume. Also, it's an election year. Typically, that means that some economic spurts and benefits may help us to kind of push the economy in a better light for an election. So I think a couple of those things will lead to a rebound, but I think pricing won't rebound to another 3 to 4 years. It's going to take the bottom out and then 2 years post that to get back to where we are.
Tell me about the sort of easier ones to transact and the harder ones.
I'd say a lot of the nicer stuff, like Class A stuff, where the buyer pool, right, they sit on more cash. They're not necessarily heavily leveraged, right? Like the guys and girls that were running by night, going to get hard money because they couldn't qualify for local lending. Like they've kind of have sat on the sidelines because they can't get financing. But a lot of the bigger owner operators that have kind of deep pockets and are good connections. So I'd say a lot of like more stabilized cash flowing, like class B, class A stuff I've seen transact more so than really the value add stuff. I've actually seen a shift. I said it before, just the buyer profile shift from, I'm sure we're all familiar with the Burr model, the buy, renovate, refi, whatever the R's are in there, that more folks are now kind of in long-term preservation plays because it's a lot tougher to do that deal. Before, you can bank on cap rate compression to exit, and your value would be able to full cash out refi and take some money out as well. Those deals are not full cash out refis. You might have to cash in some regards. So kind of that play of the day is no more. It's more so just like stabilized yielding cash flow is most of the stuff that we sold this year. So from an investor standpoint, I truly think for the guys and girls on this call, like this is opportune time like no other. And this isn't just from a broker standpoint. Like I want to start buying deals too, because I think assets that should be priced higher are going to be priced a lot lower because there's not going to be as much competition, one. And two, there's still going to be that fear in the marketplace. So if you can find a good deal, like, and I think Brian said this earlier, there's going to be a lot of groups that come out of this time period and we're going to applaud them and look at them like, wow, like these guys really knew what they were doing and had the foresight to start buying when no one else did. I really think this is a really good buying opportunity in 2024 before the market starts heating up and stabilizes again.
That's what I'm most excited about for 2024 is I do feel like people are getting more moderate. Some of the council members that were running around roughshod doing a lot. I mean, frankly, a lot of hopefully shorter term and hopefully not longer term damage to the city. Like they've kind of been reined in and are at least, in the media and other constituents seeming to be, more moderate and more open to more, pragmatic ideas and business friendly ideas.
Ian and Nigel are two like real stars in this business, and I'm really glad they came on. I think both of them are excellent and highly intelligent people who do a great job. Thanks a lot for the time. I enjoyed it, and we'll hope to see you soon.